Hello and welcome back to our channel. In today's video, we'll be discussing the recent seizure of Signature Bank by New York's Department of Financial Services. According to former Congressman Barney Frank, who served on Signature's board, the bank was targeted as a message to other banks not to do business with the crypto industry. The evidence increasingly suggests that Mr. Frank may be right. Signature Bank did not invest in, trade, hold, or make loans collateralized by digital tokens. However, it did safeguard US dollar deposits of crypto companies and their customers. Crypto customers make up about 20% of Signature's deposits, which is more than at other banks but less than at the failed Silvergate Bank. Regulators seized Signature to send a message to get people away from crypto, Mr. Frank told Bloomberg Radio. "We were singled out to be the poster child for that message." Signature otherwise had a diverse deposit base that included many top New York law firms and real estate developers. Until last week, its greatest balance sheet risk appeared to be its heavy footprint in New York real estate. Like other banks, its assets also suffered from duration risk owing to rising interest rates, which could cause losses if it had to liquidate securities to redeem deposits, as it did last week. On Friday before its weekend closure, Signature lost $17.8 billion in deposits. But the bank had $4.54 billion in cash and $26.4 billion in marketable liquid securities. It also reported $25.3 billion in borrowing capacity. Regulators haven't directly disputed that the bank could have survived the run. The state's Department of Financial Services said it took possession of the bank because it failed to provide reliable and consistent data, creating a significant crisis of confidence in the bank's leadership and its ability to do business in a safe and sound manner on Monday. Does this mean regulators can seize any bank whose executives it doesn't trust? First Republic Bank's problems appear larger than Signature's, yet regulators orchestrated a $30 billion deposit injection from big banks to prevent its collapse. Perhaps, as Mr. Frank suggests, regulators may have taken down Signature as part of their campaign to take down the crypto industry. On January 3, the Federal Reserve Board of Governors, Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, OCC, issued a statement that they have significant safety and soundness concerns about bank crypto exposure and would closely monitor crypto asset-related exposures. A few weeks later, the National Economic Council issued a policy statement discouraging banks from transacting with crypto clients. On February 23, the Fed, FDIC and OCC issued another statement warning banks about potential liquidity risks from stablecoins, which are backed by hard currency reserves and are supposed to hold a fixed peg to the US dollar. Signature held reserves backing stablecoins. Regulators are ostensibly concerned that crypto customers could rush to redeem stablecoins all at once, causing a drawdown of deposits that creates a liquidity squeeze. This shouldn't be a problem for banks with diverse deposit bases, and the risk of a deposit run isn't unique to crypto, as we've seen this week. Regulators ironically fueled the liquidity squeeze that they are ostensibly trying to prevent by spooking Signature depositors about its crypto exposure. By making crypto politically toxic, they also concentrated crypto deposits at banks like Silvergate and Signature. Following the government's Signature seizure, crypto companies say they are struggling to get other banks to take their deposits. While the FDIC is ostensibly trying to sell Signature to another bank, Reuters reports that two sources said any buyer must agree to give up all the crypto business at the bank. The FDIC denies this. The consequences of regulators' actions are concerning not just for Signature Bank and its crypto customers but for the wider financial system. The government's intervention in the banking system raises questions about the role of regulators and the extent to which they should be allowed to intervene in the market. In a free market, banks should be allowed to decide which customers they want to do business with, based on their own risk assessments and business strategies. The government's intervention sends a chilling message to banks that they cannot do business with certain industries or customers, based on political or ideological considerations. Moreover, the government's actions could have a chilling effect on innovation in the financial sector. The crypto industry has been one of the most exciting areas of innovation in finance in recent years, offering new ways to store value and transfer money. By cracking down on banks that do business with the crypto industry, the government risks stifling innovation and driving it underground. In conclusion, the seizure of Signature Bank raises important questions about the role of regulators in the banking system and the risks of government intervention in the market. While there may be legitimate concerns about the risks associated with the crypto industry, regulators should not be allowed to use their powers to target specific industries or customers based on political or ideological considerations. A free and open banking system is essential to a healthy financial system and a thriving economy.